Your state pension pays you £11,502 a year. Your private pension adds £24,000. That's £35,502. Just £502 over the line. And because of that £502, HMRC is going to take back every penny of the £200 winter fuel payment you received in November. Not £502 worth, not a proportionate slice, the entire £200. Gone. Collected through your tax code starting April 2026 at roughly £17 extra tax per month for 12 straight months. You won't receive a bill. You won't receive a request. HMRC will simply change your PAYE code, deduct the money from your pension before it reaches your bank account, and send you a letter in April explaining what they've already done. The threshold is £35,000 in total taxable income, not £35,000 in earnings, not £35,000 after deductions. Total income, pensions, savings interest, dividends, rental income, everything except ISA returns and capital gains. £1 over and the entire payment vanishes. This is the winter fuel payments charge. It came into force for the 2025/26 tax year under the Finance Number 2, Act 2026, and it affects an estimated 2.2 million pensioners across the United Kingdom. Most of them have already received the payment. Most of them don't yet know they'll have to give it back. And a significant number, pensioners whose income sits within a few £100s of that £35,000 cliff edge, could have kept the money entirely if they'd understood one or two planning decisions before the tax year ended in April. That's the part that stings. This isn't like the high-income child benefit charge, which tapers gradually between £60,000 and £80,000. The winter fuel payments charge has no taper, no sliding scale, no gradual reduction. It's binary. Below £35,000, you keep £200. Above £35,000, you keep nothing. The Resolution Foundation flagged this as a significant design flaw when the policy was announced in June 2025. The Institute for Fiscal Studies raised the same concern. The government pressed ahead regardless. If you're a UK pensioner with total income anywhere between £33,000 and £37,000, the next 20 minutes could determine whether you lose £200 this year, £400 over the next 2 years, or nothing at all. I'll show you exactly how the charge works, who's exempt even above the threshold, what counts toward the £35,000 and what doesn't, and there's a planning mechanism that can legally reduce your income below the line that most pensioners have never been told about. I'll get to that in the second half. First, the mechanics. DWP pays winter fuel payments automatically to everyone over state pension age who was born on or before the 27th of June 1960 and lives in England, Wales, or Northern Ireland. You don't need to claim. You don't need to apply. The money arrives in November or December, deposited into the same account that receives your state pension. For the 2025/26 tax year, the qualifying week was the 15th to 21st of September 2025. If you met the age and residency conditions during that week, you received the payment. The payment itself is not taxable income. That distinction matters. HMRC doesn't add £200 to your income and tax it. Instead, a separate charge, equal to the full value of the payment, is levied against anyone whose total income exceeds £35,000. The practical effect is identical to a 100% clawback, but the legal mechanism is different, and that difference creates specific consequences for how it interacts with your tax code. Norman Burkett, 74, from Solihull, has a combined pension income of £34,200, state pension plus a small local government scheme, well under the threshold. He received £300 because he's over 80. He keeps every penny, no charge, no tax code change. His neighbour Valerie Sefton, 69, also from Solihull, receives £33,800 from 2 private pensions plus her state pension. But Valerie also has £18,000 in a savings account, earning 4.65%. That's £837 in annual interest. Her total income, £34,637, still under the threshold. Valerie keeps her £200 as well. Now consider Derek Rushworth, 71, from Doncaster. Derek's pension income totals £34,400, almost identical to Norman. But Derek also receives £900 in dividends from shares he inherited from his father in 2019. His total income, £35,300, £300 over the threshold. HMRC will recover the full £200, not £3 in proportion, the full £200. And because Derek doesn't file self-assessment, HMRC will recover it by adjusting his PAYE tax code for the 2026/27 tax year, adding roughly £17 per month in extra tax deductions from his private pension. Derek phoned the HMRC helpline in March 2026. He waited 38 minutes. When he finally reached an advisor, he asked whether he could make a charitable donation to bring his income below £35,000. The advisor told him the truth, and it wasn't what he wanted to hear. Here's the problem. The £35,000 threshold is measured against total income, which in tax legislation means Step 1 income under Section 23 of the Income Tax Act 2007. That's your gross income from all sources before any deductions for gift aid, personal pension contributions paid from net income, or trade losses. This is different from adjusted net income, which is the measure used for the high-income child benefit charge and for tapering the personal allowance above £100,000. The distinction is critical. If you donate £500 to charity through gift aid, your adjusted net income drops by £500, but your total income does not. The winter fuel payments charge uses total income. Gift aid won't save you. Personal pension contributions from your own bank account, paid net of tax relief, won't save you either. Derek's £500 in dividends could not be erased by writing a check to the British Heart Foundation. I'd be curious to know, has anyone contacted HMRC about this and received different advice? Because the early guidance published on gov.uk in November 2025 wasn't entirely clear about which income measure applied, and some tax professionals have told me that helpline advisors gave inconsistent answers in the first 3 months. If that happened to you, tell me in the comments. I'm tracking these cases. So what does work? One mechanism, and it's the only one that reliably reduces total income rather than adjusted net income, is salary sacrifice into a workplace pension. If you're still employed, even part-time, and your employer operates a salary sacrifice scheme, the sacrificed amount never forms part of your taxable earnings. It reduces your gross pay before it's reported to HMRC. Your total income drops. But most pensioners aren't employed. Most receive pension income from schemes they left years ago. For them, salary sacrifice isn't an option, and that raises a harder question, one that the government has deliberately left unanswered. Can you defer income to stay below the threshold? In theory, yes. If you control the timing of certain income, for instance, delaying a pension drawdown payment from March to April, or instructing your investment platform to hold dividend payments until the following tax year, you might keep total income below £35,000 in 1 year while accepting it'll be higher the next. Some tax advisors describe this as legitimate timing. Others argue HMRC could view repeated deferrals as tax avoidance. The legislation doesn't explicitly address it. The gov.uk guidance is silent on the point. Everything I've told you so far assumes you don't qualify for an exemption, but there is one, and it overrides the £35,000 threshold completely. If you were entitled to any of the following benefits during the qualifying week, the week of the 15th to 21st of September, 2025, you are exempt from the winter fuel payments charge regardless of your income. Pension credit, income support, income-based job seekers allowance, income-related employment and support allowance, universal credit. Entitlement on any single day during that qualifying week is enough. You don't need to have received a payment during that week. You don't need to have claimed during that week. You need to have been entitled. If any of what I've just described made you pause, if you've been wondering whether your income is above or below that line, or whether you should have opted out, or whether HMRC already has your tax code marked for recovery, hitting the like button takes 2 seconds, and it tells the algorithm to push this toward other pensioners who are opening these tax code letters right now without any explanation. That genuinely matters. Now, the case that reveals how badly this system can misfire. Phyllis Okonkwo, 67, from Reading. Phyllis retired in July 2025. She receives a state pension of £11,502 and a defined benefit pension of £22,300 from her former employer. Total pension income, £33,802, comfortably under £35,000. She received her £200 winter fuel payment in November 2025. She assumed she'd keep it. But in January 2026, Phyllis withdrew £5,000 from her SIPP to cover a bathroom renovation. Her pension provider applied the emergency month 1 tax code and deducted £1,000 in income tax at source. Phyllis assumed the £5,000 was already taxed and done. The problem, that £5,000 counted as taxable income for the 2025/26 tax year. Her total income rose to £38,802. She crossed the threshold by £3,802. HMRC will recover the full £200 winter fuel payment. It gets worse. Because Phyllis's pension provider used the emergency code, they deducted £1,000, but her actual tax liability on that £5,000 was £1,000 at basic rate anyway. So the tax itself was correct. But the income pushed her into the clawback zone. Had she waited until April 6th to make that withdrawal, 4 working days later, the £5,000 would have fallen into the 2026/27 tax year instead. Her 2025/26 income would have stayed at £33,802. She would have kept her £200. 4 days. That's the margin. Phyllis's case isn't unusual. The Association of Taxation Technicians estimated that approximately 300,000 pensioners sit within £2,000 either side of the £35,000 threshold. For those pensioners, the timing of a single pension withdrawal, a one-off dividend, or even a bonus interest payment on a maturing fixed-rate bond can be the difference between keeping the payment and losing it. I know this sounds like a lot of rules layered on rules. It's a lot of numbers, a lot of thresholds, and none of it was designed to be straightforward. But here's the part that matters to you right now, in August 2026. The 2025/26 tax year is already closed. If your income exceeded £35,000, the clawback is coming, either through your tax code this year or through your self-assessment return due by the 31st of January 2027. You can't change last year's income, but you can change this year's, and you can absolutely plan for next year's. The 2026/27 tax year started on the 6th of April, 2026. The qualifying week for winter 2026/27 is the week beginning the 21st of September, 2026, 6 weeks from now. If your income for the 2026/27 tax year exceeds £35,000, HMRC will recover your 2026/27 winter fuel payment as well. And from the 2026/27 tax year onwards, HMRC has announced a change in recovery timing. Instead of collecting 2 years' worth in one go, they'll recover the charge within the same tax year you receive the payment. That means faster deductions from your pension. This next part, a lot of pensioners tune out because it sounds like accountancy. Don't. This 90-second explanation could be the difference between keeping £200 and losing it for the next 5 years running. If your total income is between £33,000 and £36,000, you have exactly 4 levers to pull. 1. Maximize ISA contributions. ISA income doesn't count toward the £35,000 threshold. If you move £20,000 from a taxable savings account into a cash ISA at the start of the tax year, the interest on that £20,000 disappears from your total income calculation. At 4.5%, that's £900 in interest that HMRC no longer sees. 2. Deferred discretionary pension withdrawals. If you don't need to draw from your SIPP or drawdown plan in a particular tax year, don't. Every pound you withdraw adds to your total income. 3. Consider whether dividends can be reinvested rather than paid out. Accumulated dividends within an investment wrapper don't count as income until they're distributed. 4. If you're in a couple and only one of you is near the threshold, ensure investments and savings are held by the partner with lower income where legally and practically possible. The charge is individual. It doesn't aggregate household income. If you've made it this far, you're clearly someone who pays attention to what HMRC does before HMRC does it. I'm releasing a video next week on the 5 HMRC letters every new retiree receives and the one that carries a £3,200 penalty if you ignore it. Subscribing means you'll see it when it drops. And given that 1.8 million simple assessment letters are already landing on doormats, the timing is tighter than you'd think. Here's what nobody connects. And this is the part that changes how you see this entire policy. The £35,000 threshold for the winter fuel payments charge and the £50,270 threshold for higher rate tax are not independent. If your income exceeds £35,000, you lose your winter fuel payment. But if it exceeds £50,270, something else happens simultaneously. Your personal savings allowance drops from £1,000 to £500, meaning HMRC collects additional tax on your savings interest. And if your total untaxed income, including savings interest and dividends, exceeds £10,000, HMRC can issue a notice to file self-assessment under Section 8 of the Taxes Management Act, 1970. Once you're in self-assessment, you stay in self-assessment. 3 thresholds, 3 consequences, each one triggers the next. A pensioner earning £36,000 with £1,200 in savings interest doesn't just lose the winter fuel payment. They also owe tax on the £200 of interest above their PSA. And if they have additional untaxed income, rental income, dividends, an incorrectly coded pension, they could cross the self-assessment threshold without realizing it. The system compounds. The thesis of this entire video comes down to one sentence. The winter fuel payments charge doesn't exist in isolation. It sits inside a web of thresholds that punish pensioners who don't know where the lines are drawn. Your action plan for this week: Monday, log into the gov.uk winter fuel payment calculator at gov.uk/guidance/paying-back-the-winter-fuel-payment and enter your expected income for 2025/26. See whether you'll face the clawback. Tuesday, check your 2026/27 PAYE tax code. If it contains an unexplained reduction in your tax-free amount, that's likely the clawback already built in. Call HMRC on 03002 003300 if the code doesn't match your expectations. Wednesday, calculate your projected total income for 2026/27. If it's between £33,000 and £36,000, speak to an accountant about the 4 levers I described. Thursday, If your income is clearly above £35,000, consider opting out of the winter fuel payment for 2026/27 through the DWP online form on gov.uk before the qualifying week in September. Opting out avoids the clawback mechanism entirely. Friday. If you hold savings in taxable accounts, calculate whether moving funds into ISAs before the 5th of April 2027 would bring your total income below the threshold for the 2026/27 tax year. The connection between Phyllis's January SIPP withdrawal and Derek's inherited dividends is this. Neither of them understood that every pound of income, from every source, at every point in the tax year, feeds into a single number. And that single number determines whether they keep £200 or hand it back. The system doesn't distinguish between pension income you need and dividend income you forgot about. It adds, it compares, it deducts. Let me return to where I started. Your pension income of £35,502, that £502 over the line. HMRC processes roughly 12.3 million winter fuel payments. Of those, 2.2 million recipients have incomes above £35,000 and will face the charge. That's not a small group. That's 1 in every 5.5 pensioners who received the payment. Derek Rushworth, the pensioner from Doncaster who phoned the helpline in March. His story doesn't end at the £200 clawback. When HMRC adjusted his tax code in April 2026, the adjustment pushed his monthly take-home pension down by £17. He phoned again. Another 34-minute wait. The advisor confirmed the code was correct. Derek asked whether he could opt out of next year's payment. The advisor said the opt-out window for 2026/27 opens on the 1st of April 2026. Derek opted out on the 3rd of April. He'll keep his tax code clean for 2027/28. A small victory, but it took 2 phone calls, 72 minutes on hold, and a clawback he couldn't reverse. The next video covers the 5 HMRC letters every new retiree receives, and one of those letters is the tax code notification that carries the winter fuel clawback embedded inside it. If you didn't know to look for it, you'd never spot it. That video drops next week. £200 won't change your life, but the principle behind it, that the government can pay you money, demand it back through your tax code, and offer no taper, no warning, and no grace period. That changes how every pensioner in this country should think about the line between income they control and income that controls them.